My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Deborah Fuhr. Deborah, introduce yourself here to the audience. Who are you? How'd you get involved in markets? What have you done throughout your career? And what are you doing currently?
Great. So, it's great to be here. So, my name is Deborah Fuhr. I'm based in London. I started my career early days at Greenwich Associates, a consulting firm. So, I worked with Charlie Ellis, who was the founder, and he really believed in passive investing and indexing. He also was the first to do the analysis in the Financial Analyst Journal on how many active funds do not beat the S&P 500. So, kind of ingrained in my head early on was the idea that indexing made sense, and really enjoyed working around the world with him. Had the chance to get involved with ETFs starting in 1997 at Morgan Stanley in London, where I was hired to be the director of marketing for a product we had at Morgan Stanley called Opals, which were very much like ETFs. They were a family of MSCI and local benchmark products that were listed in Luxembourg. When someone bought, we did a program trade. When someone sold, we would unwind doing a program trade. At the time, there were 21 ETFs and $8 billion invested. Morgan Stanley helped to create iShares. So they partnered with BGI and MSCI, so Barclays Global Investors and MSCI, created 17 MSCI country ETFs called Webb's World Equity Benchmark Shares. 99 BGI rebranded them to iShares, and the rest is kind of history. Spent 11 years at Morgan Stanley as a managing director in sales and trading. So I sat on the trading floor, was writing research until Spitzer came along. Then it became market commentary. I then fixed income took over equities, and I moved to Barclays Global Investors and started on the day Lehman filed for bankruptcy. And I was an MD brought in to create industry research and work on implementation strategies. So the landscape reports that BlackRock publishes today are a much smaller version of what we used to publish every month, and we produced a directory. I accepted a job to join Merrill as a global head of Delta One strategy, resigned from BlackRock, then Merrill Lynch reorganized. I decided I would set up my own company. My company just turned 11 years old. We publish independent research on all ETFs listed around the world, including there are ETFs in Iran. We work hard to get data when there's BDRs or certificates in Brazil, Argentina, etc. So I would say we are probably the only place that covers everything around the world that's an ETF or ETP. And we publish about 4,000 pages of charts analysis, make a fact sheet for every product. And we also do events, and we do a TV show called ETF TV. And then I'm one of the founders and board members of Women ETFs, a nonprofit in the US, and a limited liability company in Europe, co-president of EMEA for that. And we have over 8,400 members. I'm on 2 fund boards, and I'm on a public company board. So that's my quick, brief bio.
What was the initial response by the industry to ETFs in the 90s? Was there a lot of pushback back then, as you remember? Was there some interest, but nobody ever thought it would really overtake mutual funds? I mean, what was how did the evolution of the thinking towards ETFs change over the years?
That's a great question. Most people would say to me, "Are you going to pay me rebates or retrocessions to sell ETFs?" And when I said no, they either hung up or said, "Have no interest in seeing you."
Okay, and hold on, because that's actually, before you continue on that, because that's actually a really interesting kind of inside baseball point about mutual funds versus ETFs. Explain what that means for the audience.
So normally, and it's still true today in many countries, many financial products will pay private bankers or advisors to sell the product. So they will get potentially front end fees, back end fees, annual fees. And back in the day, that was the case across Europe. That has changed. We've had the retail distribution review and other regulatory changes that felt people didn't realize that the advisors were being paid to sell products, and therefore the retail clients maybe weren't getting the right or best products or weren't being dealt with in the most appropriate ways. Is that good enough?
Yeah, and I think the key point there for the audience is that it's not quite sort of a pay to play, but you got to pay to get on the shelf.
Correct. Yes. And ETFs don't do that by and large. I mean, there was an attempt to pay to get on the shelf in Canada for a while. So they had advisor share classes where they did offer to pay the advisors to sell. That really didn't work well. And so that type of product went away in Canada. So, as far as I know, that's really the only place that tried to do that. We also have had institutional share classes offered by one of the firms in Europe for a while. So, if someone was coming in with a larger size trade, they would get a lower cost product. That also didn't work well and went away.
So that over the several years that, post the ETF first ETF launch with SPY, that was a real stopping point for quicker adoption because you had these vested interests to get those fees from the mutual fund structure as opposed to the ETF structure.
True, and I should correct because everyone expects me to. The first ETF technically was listed and still alive in Canada. So March 9th, 1990 was the first ETF globally. US just celebrated its 30th anniversary in January. So many would say, well, Canada heard about what the US was doing and got to market first, but it did get to market first. So Canada was first.
Okay, now you had mentioned the background on the consulting side, the passive indexing focus. First, let's go through the actual research because I'm always skeptical of the idea that's put out there a lot that passive beats active because a lot of what's considered active, I'd argue, is not really active. The R squared for most active funds is like 99%. So when you first, let's distinguish between active versus passive. How do you define something as an active strategy versus something that's passive?
Yeah, so for me, if something states it's designed to track an index, then it's an index tracking product. And I prefer to use index as opposed to passive because many people generate alpha through getting their asset allocation right. And I do think it is difficult to find funds that say they're actively managed with the goal of beating a benchmark that actually do beat their benchmark. And that includes hedge funds. And so if you look, and I do believe in the SPIVA study, so S&P does these studies where they look at how many active funds did not beat their benchmark over the past year. And especially in the US, you see that the percentage of funds that have underperformed the benchmark, on average, 7 out of 10 funds do not consistently beat the S&P 500. And the thought being then that if you just buy a low cost index tracking product like an ETF and you get your asset allocation right, you can generate more easily alpha through that process as opposed to spending a lot of time trying to find an active fund that's delivering alpha and charging higher fees.
But I think the fee part is the critical distinction, right? So I have to assume a lot of the attribution around that is because of the net of fees performance. So then that's why passive tends to outperform. It's more of a fee differential.
Well, it is. It's performance because of fees, correct? Yes. So many, I mean, you think about hedge funds thinking it's, 2 and 20. Many active funds feel they should be paid significant fees to deliver that alpha, but those high fees are often the reason they don't deliver that alpha.
Right. And I think where that gets to be interesting from the industry perspective is uh, while there might be a lot of blame on active versus passive, especially in the mutual fund world, I would argue that it's because of the earlier point of the conversation that there's this kind of pay to play aspect of being on the shelf that causes fees to also be higher that makes the data probably skewed. It's not necessarily because the manager is unable to outperform, it's because they're forced to charge higher fees because of the need to actually be on the shelf and pay the platforms to just have their advisors have access to those funds.
I think that's true in many cases, although I think many people feel they should be paid more for delivering that alpha, and therefore their work should get paid more than an index fund. So I think it's a little bit of both. It's not just getting on the shelf. I think people think they deserve to be paid higher fees.
What about the idea that certain parts of the marketplace are more likely to generate alpha opportunities than others? So for a long time, it was touted that small caps, for example, are much more inefficient than large caps. Although if you look at the Russell 2000 divided by the S&P, the performance has been the same basically since 1987, with a lot more volatility in small caps. Are there any studies or anything that you've looked at that would suggest that you're more likely to have alpha even adjusting for reasonable fees in certain parts of the marketplace as opposed to just large caps?
many people would believe that in emerging markets and markets where it's hard to get good data, that active funds tend, if they know what's going on, are able to get data, make better investment decisions, and therefore generate alpha. So I have seen that mentioned in many cases. I think small cap could be another case where it's also the ability to invest, right? Because one of the big challenges is if you are running a strategy that could get large, do you have the capacity to buy a lot of small cap names? Because remember, if you're using an ETF or index strategy where they have to go out and buy all the shares, it can become a challenge as the fund gets bigger and bigger, being able to buy the underlying securities that you should buy to track the index. So I think there's a number of challenges when you think about emerging markets or small cap. What strategy works is partially driven by capacity issues also.
Which is interesting, right? Because if that's the case, then the very structure of a mutual fund or ETF, unless you were a cap, in which case it wouldn't be an ETF, be a closed-end fund, you're not going to necessarily have, sort of just by the nature of the vehicle, the likelihood of a product coming out that would really generate outperformance because of the limiting size issue.
That's definitely true. And that's been one of the challenges when people look at creating ETFs in certain markets. If a set of securities don't trade every day and they aren't very liquid and there's not a lot of free float, it makes it very challenging to make an ETF. So not every strategy makes sense for ETFs. They have to be liquid, tradable, the taxes have to make sense. So there are some requirements that are needed. It's like many people used to say to me, oh, they'd come in and meet with me and they'd say, I want to convert my hedge fund into an ETF because it will make it more liquid. Well, that's not true, right? Because you have to be able to trade the underlying every day, whether it's creations or redemptions. So there's no magic liquidity in ETFs. You really have to understand what's inside of it and the structure of an ETF and how it works.
Let's talk through some of the evolution of the types of products or types of strategies that have uh, come out on the ETF industry space. So a lot, obviously, was passive initially. That was the initial amount of flows. We got to a point where there was saturation on thematic ETFs for a bit of time there. Now there's a little bit more focus on active, given volatility. Just talk through some of the trends that you've seen over time in terms of these kind of types of launches, which seemingly come out of nowhere, but they all tend to be focused on a particular idea.
Yeah, so that is a great question. So it's important to remember, like for the first from 1990 until really 2000, the ETFs were really focused on equities. And today, globally, if you look, the equity component of the global landscape is still 73% of all the assets in equities. Fixed income came out, and they were initially treasury products. We then saw some leverage and inverse products come out. A lot of these actually came out in Canada. So Canada really has been innovative, although rarely getting credit for it. From there, emerging markets was something that institutional investors really liked buying and using emerging markets. Often in the beginning, they were using ADRs and GDRs to be able to have liquidity during US market hours. And that was more because how people thought about using ETFs was more about they wanted quick and liquid access to emerging markets as opposed to seeing it as a longer term investment product. And that same ETF, EEM, as it grew over time, investors who were using it wanted it to be an investment product with better tracking. And so you found that it was moving towards buying the actual underlying shares. So you've seen the first active product came out in the US in 2008, and talking about people thinking about ETFs as being indexed. That was from Bear Stearns, and the ticker was YYY. And if Dan is on the phone, I'm sure he'll remember that. Many people's reaction is, why do we need active ETFs? Everyone thought index products made sense. They were low cost. They were transparent. I think it's only recently that we've seen that active ETFs have really been embraced both by investors a bit more, but also by, in the US, many of the firms who said they would never get involved with ETFs, they wouldn't use them, wouldn't launch them, have started to transfer or convert mutual funds into ETFs. And it's been interesting because many of them had said they wouldn't provide ETFs because they valued the non-transparent way mutual funds work. You don't know every day what's inside of it, and that protecting the secret sauce was really important for their portfolio managers. Interestingly, many of the new entrants who have converted mutual funds into ETFs have gone for the fully transparent version of active ETFs. And so we've seen Capital Group, we've seen Dimensional Fund Advisors, T. Rowe Price has come in, Putnam has come in. I believe that over the next few years, we will see that almost every asset manager will have some ETFs, partially because the end investors want them. We've also seen, as you said, thematics became really popular, especially during COVID. So I would say that during COVID, many people, especially men, being a little stereotypical here, but everyone was sitting at home. Men's hobbies tended to be outside their homes. Many of them turned to trading, investing, following the market. And thematic ETFs were a good way to use ETFs to invest in something that was more exciting than buying the S&P 500. And so people would listen to like CNBC, you'd see, the press people talking about what's going up or down. People on the air would be talking about where they think the market was going to be going. They'd name ETFs and tickers. And many of the TV shows in the US became basically the ways people learned about investing and about ETFs. And we know that in 2021 in the US, 15% of the investors in the stock market were new investors. So a lot of them, I believe, saw thematic ETFs as an alternative to buying individual securities because they helped them to identify which securities belonged in if you wanted to invest in work from home or gaming or, jets for airlines. It allowed them to talk to their friends about something exciting they had done as opposed to saying, hey, I just bought the S&P 500. Isn't that exciting? I think that's one that you really need to ask the people who are converting products. But basically, the ETF structure allows you to recognize the gains or losses when you're actually selling your ownership of the ETFs. And that's been one of the benefits that has happened. But given many of these conversions have long histories, I wouldn't be able to dive into the weeds on any of them at this point. Sorry. So Canadian people should buy Canadian ETFs for the best tax consequences. Really, because when taxes are done, they always, even for US ETFs, so I'm sure you have people who are not from the US. Anyone who is not a US citizen who buys a US domiciled ETF is going to suffer 30% withholding, whether it's an ETF or mutual fund for that matter, because mutual funds and ETFs in the US have to pay out income at least once a year. And the US withholds 30% if you are not a US person. And so when that is withheld, you can reclaim some of it by filing W-8 Ben forms. But the real disadvantage for non-US people is you potentially and most likely will become eligible for US inheritance tax. And this is the reason that many people, including Canadians, don't want to buy US listed ETFs is nobody wants to have to pay US inheritance tax if you don't have to. So increasingly, you see people in Canada buying Canadian products. You see people outside the US buying ETFs that are called UCITS or European domiciled, and it stands for Undertaking for Collective Investments in Transferable Securities, because the UCITS version of ETFs allows you to accumulate. You don't have to pay out income. And when income is paid out, there's no further withholding. And we also have the ability in Europe to have the same ETF listed with multiple currencies. We can have currency hedge versions. So there's a number of benefits that we have in Europe that are not available in the US, where everything trades and settles in dollars. My understanding would be it used to be that there were ETFs offered by issuers in Canada that often would hold just a US underlying product in it. And so you'd end up with two levels of fees. So I don't know of any benefit for Canadians buying US. If anything, all I'm aware of is that it's not beneficial for Canadians to buy US products.
So always been an interesting dynamic with ETFs in terms of investor behavior, which I think is worth focusing on for a bit here. ETFs, it's touted, right? Okay, liquid, you can get in and out, great. But the problem is that ETFs, because they trade second by second, I'd argue create an incentive to trade and overtrade in particular. I've seen studies that would suggest that investor returns in a mutual fund tend to be higher than investor returns in an ETF, purely because it's not in a mutual fund, it's priced once a day. ETFs priced second by second. And if you're only seeing data updated once a day, you're less likely to trade off of noise. I wonder if you've seen similar studies and if you think that there's sort of a dark side to using ETFs in that way.
I think the challenge of generalizing with ETFs is, if you look at who uses ETFs, we're kind of cleaning data right now, looking at who reported holding any ETF listed globally. And we found that there's over 7,500 institutions that are using one or more ETFs out there. And so when you think about, you have institutions using them, you have financial advisors, and you have end retail. So ETFs are unique in that they're really the only democratic product where you have all of these different types of organizations, hedge funds, pension funds, mutual funds, advisors, and retail using the exact same product, same annual cost, same small minimum investment size. For many institutions, the way they think about ETFs is they could be using them as a hedge, right? So they're using them to hedge their position, and they're doing that on a day to day basis. Others will be using ETFs to equitize cash. So many mutual funds want to keep some of their investment in a very liquid holding, such that if they had redemptions, they could sell very quickly. Others will be using ETFs as a satellite. They could be using it as part of a transition. And so the challenge is you have ETFs being used in so many different ways by so many different organizations that it in general looks like a lot of trading is happening. But in general, I would say that there's a lot of people who are holding their ETFs for very long periods of time. And maybe what they do is rebalance back to their benchmark weights. Like you think about the growth of model portfolios in the US, the asset allocation for many of them stays the same. But if equities outperform, internationally versus US, you rebalance to your benchmark weights, maybe quarterly, 6 monthly, or annually. So I don't buy the story that ETFs are all being bought and sold more quickly than mutual funds. I think that mutual funds are not used and shouldn't be used the way ETFs are being used. Most mutual funds do not want investors to go in and out, and actually would encourage you, if you are going to be using it to equitize cash, or you can't even use them as a hedge, that you should use something like an ETF. So I think it's because there's many different ways ETFs are being used that you see the trading volume.
So you said something fairly quickly at the start, which caught my attention. Did I hear that right? You said there's ETFs in Iran.
Yes.
Okay, so you got to help you got to help me out on this in the weeds as far as ETFs in other countries. So let's talk about the evolution of and growth of ETFs outside the U.S. and outside of Canada to countries like Iran, because that sounds really actually remarkable.
Yeah, and I'm lucky. I mean, a number of years ago, I was invited by the regulator to go there and speak. So I've actually been there. And they do have some unique features. They have ETFs because they follow Sharia law, and so interest is not allowed. So they actually have ETFs that invest in physical real estate. So they'll build apartments or whatever, and then eventually sell, and that's how they pay back. So the structure is slightly different, and it's much smaller than in other markets. But there are 25 products listed in Iran right now. We have ETFs in Vietnam. We have ETFs in Kazakhstan, Malaysia, Pakistan, Taiwan, Thailand. They're really all over the place. I mean, I've been lucky, and over the years, I've been to 65 countries talking about ETFs. And every time I go somewhere, it's very interesting to be able to meet people, talk at events, hear how and why ETFs are working or not working in certain jurisdictions, and how they're trying to make them resonate for that entire ecosystem of retail advisors and institutions.
And I'm curious, just the I'm going to assume that those ETFs are not going to be as thematic as what we see in the States. That the innovation level is probably not to the same level.
That is correct. So they're more kind of standard exposures. We talked about thematics. In the US, we've had smart beta, We've had ESG, which clearly, there are nuances of what is appropriate in different countries. When you think about, environmental social governance, what works in one jurisdiction may not be the same in other emerging markets. So yes, the products are different, but clearly, the thought and appeal of ETFs being low cost, transparent, easy access has been something that resonates around the world. Today we have ETFs listed on 81 exchanges in 63 countries. That's a great question. I think some family offices have embraced ETFs for a long time. I can remember meeting many back when I was at Morgan Stanley, right? So way before 2008. But I think it very much depends on the family, where, when, and how they're investing, and who their financial advisors are or is. That helps them to understand why, when, and where an ETF could be a useful vehicle for them. So, what I've seen over the years is quite often the advisors to family offices and even consultants that cover pension funds didn't like to talk about ETFs because why would you pay me to tell you to buy an ETF that's low cost, transparent, even if there are different underlying benchmarks or different structures? They would prefer to get paid to talk about hedge funds or active strategies and bring in managers and feel like they're getting paid so that their family feels like they're doing the work that would warrant them being paid. So I think it's a little bit about the advisor ecosystem for families that have often made it difficult for ETFs to be something that would be on the list of things they would even be told about.
Let's get into the current environment for a bit. Given it's still obviously close to the start of the year than not. What are some of the more interesting flows and things that you've seen in your work and your data, as far as where retail institutional is focusing on gains, withdrawals, any kind of interesting insights there?
Yeah, so if we look at the flows for January, although we're just finishing up February, but given January just passed, what we see is the net flows for January were basically 60 billion. So when I talk about net flows, what I'm discussing is creations versus redemptions. So I'm not just talking about how much money was moving around day to day, it's really that net difference. So it was 60 billion. And when we compare that to the first month of last year, it was 76 billion. So we're slightly down from last year. This year, so far, the money has been going into fixed income a little bit more than equities. So 27 billion went in net to fixed income, 22 into equities. Active ETFs, as I mentioned, has been seeing net inflows. So we saw 10 billion go in there. The leverage and inverse products have seen net outflows so far this year. And when we dive into that, it is interesting because in Europe, investors really are believing in ESG. So there's much more investment in ESG strategies, partially because regulations are causing investors to need to invest in this fashion, but also because I believe Europeans feel more strongly about the environment and social and government issues and really want to invest with that lens. Um, I think what we're also seeing is that women investors are becoming a very important audience for many people. And I think it's partially because women live longer. Often, when there is a divorce between a couple, the women tend to move to a different advisor. They are tending to be more conservative. Um, so I think people are focusing in on different cohorts of investors. I think also you find younger investors also tend to have a more ESG friendly view when they think about investing. Crypto, we have a lot of crypto products in Europe, and we are seeing that, last year, even though it was a terrible year for cryptocurrencies and the market overall, we did see that the industry still took in nearly $100 billion. So it wasn't as if there were net outflows as we saw, say, in gold last year. So it is interesting how I think some of the people who've invested in crypto are long-term believers in cryptocurrencies, and there wasn't this mass exodus. Um, I think the other thing we're seeing is smart beta has come back. So many people are looking at high dividend products and looking for income. You know, and I think, many people have really applauded Kathy Wood. I think she's been a successful person, although challenged on some of the things she's done. But she's really been transformative, I think, and maybe getting some of the larger active managers to be comfortable in sharing everything they do, because she's fully transparent on her research, on her trades, on all her holdings. And she really does have strong opinions on what she does and how she's doing it.
Is any of that surprising to you as far as just the where the flows have gone after a year like last year? I mean, bad for stocks and bonds. Rebalancing, you can argue, really didn't matter too much because they both kind of behaved roughly the same. So maybe there's not so much incremental buying or selling across the two. But has anything kind of struck out to you as being a bit of an outlier?
Um, well, I think one thing that is kind of interesting, and many people might not know this, is we have had 44 months of consecutive net inflows into the ETF industry globally. So you think about other investment products, and there's definitely been many months where there's been net outflows. So I do think investors have really embraced and like and used the ETF structure when they're investing in many different asset classes. In some ways, I guess I'm a little surprised that, given the war in Ukraine still going on, what's going on with China, uncertainty around the Fed and central banks, it is surprising a little bit that so much money is still going into equities. So there still is this thought of a risk on for many investors, which, when you listen to other people, they're quite concerned about various things that are out there, political, economic news. And there clearly is kind of people, I think, on either side of the camp there.
Right, which is interesting because that's very much counter to the popular narrative that you hear that we're in a bear market. This is going to take a while, but dollar flows would suggest there's still quite a bit of confidence despite last year.
Well, I think especially going to equities, right? If you have 22 billion going into equities and 27 going into fixed income, I mean, clearly we've seen many investors going into, treasuries. So there are some people who are a bit more looking at the safe haven views, but I would say there's still a lot of people who are happy to be investing in the equity markets around the world, including in emerging markets.
How does that compare to other bear market periods or recessions? Is there any sort of historical comparison there that we can get some interesting insights on?
One thing that is interesting is often when there are stress points, ETFs tend to take more net inflows than other products. If we go back to 2008, many people were concerned about any product that was issued by a bank. They were concerned about using derivatives. Many mutual funds here in Europe gated. And what that means is you can't put more money in and you can't take money out. So what we saw was during 2008, the ETF industry in Europe, when it was difficult for mutual funds, the assets invested in Europe actually increased by 11%. And I think if you go to during COVID, when there was all that concern around how would ETFs handle, significant volatility and flows in or out of fixed income, we saw that the ETFs, I believe, performed really well. And even last year, when it was a difficult year for crypto, the crypto ETPs performed really well and people continued to use them. So I think when there is stress, it often demonstrates how ETFs can be one of the preferred vehicles because you do have transparency, you have that liquidity, you can speak to multiple brokers to get pricing, and people have increasingly tried ETFs. And I find that once someone tries using an ETF, they tend to use them more, they tend to use them more often in different ways, and they tend to put more money into ETFs. So it's really getting people to try once that you find they will embrace ETFs, and you would think they were kind of using them since the early days.
What about the graveyard of ETFs, right? And I mentioned that because I think it is interesting when you have a number of ETFs that are unable to raise assets that might be thematic or focus on a particular sector of the market. That history would suggest that tends to be actually a low for that area of the market. And I'm mostly thinking about the coal ETF in this case. But any kind of interesting trends you're seeing as far as ETFs that are just not surviving in particular parts of the investable landscape?
Yeah, so I think sometimes people who are asset managers who launch an ETF don't understand that you have to go out there and sell them, right? So marketing and sales is so important with ETFs, and you have to find people where it resonates, and they have to understand the product. So I think the big challenge has always been that often people will launch an ETF and think that because you buy them through banks and brokers, that the banks and brokers are supposed to go out and sell them for you. Well, that's not what happens, right? So I think you have to have a really good, sales and marketing plan. So it's getting your 4 Ps right. You have to right price, place, promotion, and product. And if you don't have all of those things, then it's not going to work. And we've seen that, people have, I would say a few years ago, people were like launching everything and just seeing what would stick. We have moved away from that strategy, but just because you make something into an ETF doesn't mean it's going to work. So you have to make sure that you're out there, you understand where your target market is, and is this the product that is going to make sense for the clients that you're working with. So we've had products like suppliers to Walmart. Some firms that have issued ETFs have decided they weren't working and gathering enough assets. So it does typically take, I would say, for a family of ETFs, 2 to 3 years that you have to be patient. It's not going to happen overnight. I mean, sometimes it does, right? You think about a product like GLD launching gold, and it was like an overnight success. But in general, ETFs take time to mature. They have to be large enough for institutions to invest because most institutions cannot be more than 10% of the assets in a mutual fund or ETF. So if you launch an ETF with only $1 or $2 million, it's very hard to get big because it has to be slowly getting bigger and bigger until big institutions can come in. So you have to be patient, you have to be persistent, and you have to have a good story, and you have to be out there telling it. That's an interesting question. I guess maybe if you see an ETF that goes out like GLD, take GLD is out there already, and you're the second mover. And there was an example, but I won't name who, where they went out and said, okay, I'm going to price my product at half the cost of GLD. The challenge is if GLD has been an overnight success, people are not going to sell a product they just bought to buy something that's less expensive. Maybe you get them to put some new trades into your new product that's less expensive. But in general, coming out and thinking if you cut your cost, you're going to win money from someone else, people do not want to realize gains. They don't want to pay commission to sell and then buy your product. They also have the potential market move. So I think thinking about how you price your products, both initially and should you be competing on price, is an interesting challenge that many people need to think about. There are some firms who have been successful at keeping relative to others their prices much higher. I think the firm that has tended to compete more on price than others in general would be like Charles Schwab. They tend to look at trying to be lower cost, whereas you have a firm like Vanguard who adjusts their costs based on how much money is in all of their products because they run their funds to cover costs. So if fund assets go up, they lower cost. If fund assets go down, they can higher the cost to be able to cover the cost of the running of the funds. So I do think it's a great question. And I think it's one that people have to think long and hard about because just being lower cost does not necessarily mean you're going to win market share away from others. I do think, though, there is a significant first mover advantage. And being first often means you set the tone for the product because compliance people sign off on it. And most people will be happy staying in a product that assets are growing, there's trading volume, and the rest is kind of history for some of the products. I mean, look at SPY. It just celebrated its 30th anniversary, and it's still today the largest product. Some will think it's going to maybe not maintain its top of the heap rating over the next few years because other products are gaining assets. But I do think, for 30 years to be the largest ETF and the most actively traded is a pretty impressive feat, given there are other products out there.
Maybe just for the last few minutes here, and again, everybody, please make sure you follow Deborah Fuhr on Twitter. Are there any interesting things in the pipeline that you're seeing that are really innovative or unique, or could maybe get a lot of people's attention this year, or are we still in the in the phase of Me Too in terms of just copycat funds?
Well, it's not always easy in all jurisdictions to see what's coming down the pipeline. I think in the US and in Canada, you can see filings that have been put forward when they come to market can be questioned. I think what's going to drive the ETF industry a lot this year is the use of model portfolios. We're seeing that for the financial advisors using models more and more. We're also seeing that with retail investors using model portfolios more. I also think that for most of the ETF issuers, they are trying to target more the retail investors in addition to the institutions. So I think it's more about how people are using ETFs as opposed to necessarily launching a lot more products. I think if you were to think about where is product development likely to happen this year, many people would say they're focused on fixed income. I think finally people are understanding more about how and where to use fixed income ETFs. I also think the tools to do analysis allow you now to look at fixed income ETFs like fixed income exposures, as opposed to historically you were doing analysis like equities on fixed income exposure, which didn't really work well. So I would guess those are probably the key areas where I see people looking to do kind of new work.
I think that's a good place to wrap this Twitter space up, given that I have another one in about 10 minutes. Thank you, Weisskopf, for participating. Thank you, Deborah. Thank you, everybody, for joining. And stay tuned for the next conversation with Louis Gov of GovCal. Thank you, Deborah. Appreciate it.
Thank you very much. Enjoyed
Cheers.
it.